right, despite SoFi stock falling more than 10% after its earnings release, there was some really great news out of the company's financial results. I'm going to share those details with you here in this video, discussing the increases in member growth, a key financial metric regarding its loan portfolio and the performance of those loans, and why investors have several bright spots to look at from SoFi's quarterly financial results. Let's take a look here. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Right, starting with the core of the business, right? Member growth. That's the core of SoFi's business, is attracting customers, because those customers are the ones that then generate revenue by engaging with SoFi's several different products that it offers on the website and app. And new member additions were over 756,000 in the third quarter, and total members reached 9.4 million, which was up by 35% from 7 million in the same period last year. So increasingly, SoFi's services are attractive to customers. Whatever it is that SoFi is offering customers, including the very attractive savings rate, the very attractive rate you can earn by leaving money in SoFi and signing up with direct deposit. And people are not really hesitant to join because of the big thing that they don't offer, which is in-person banking, right? SoFi is primarily online and people cannot go in person to do their banking, and people don't seem to mind because so much banking is done digitally nowadays that they'd rather have all of the extra services that SoFi offers instead of the services that are offered with in-person banking. And I've been saying this for a while now. The companies that offer in-person banking, for the most part, the larger companies, I'm talking about Bank of America, Chase, and Wells Fargo, those big, and Citibank, their in-person services have been deteriorating. They've been scaling back, staffing them with fewer people, staffing them with fewer skilled professionals. I know that they no longer have mortgage professionals at the locations, at least the last time I checked. And so if you want to speak with somebody, about refinancing your home or maybe getting pre-approved to buy a home, there won't be anybody at the branch there anyways, right? You have to do that over the phone. So some of the primary reasons why you would want to go to a branch in person, they've eliminated that, right? And they handle deposits and withdrawals, and people do that through ATMs, or people deposit their checks on their phones nowadays. So this strategy of digital banking has worked really well for SoFi, and you can see that with the evidence. 9.4 million members added, and that's up 35%. Another great data point from SoFi's latest quarter was that the loan platform business grew by 5x and generated $55.6 million in loan platform fees, driven by the $1 billion sale of personal loans originated on behalf of third parties, as well as referrals. And let's dig deeper into this. So $1 billion in personal loans, if we just average that out, SoFi generates about, I think, 12% interest rates on these personal loans. And the $55.6 million is about 5% on those $1 billion in personal loans. So just, back of the envelope math here. If you take that $1 billion and you say SoFi keeps those loans and services them, doesn't sell them off to third parties, everybody pays, SoFi could generate somewhere between 12 and 14% rate of return on $1 billion in loans, but it holds the risk of huge defaults if it owns that whole $1 billion worth of loans. Or it can sell that $1 billion of loans that it originates and get $55.5 million in fees, over 5% rate of return, with close to zero risk, or a lot lower risk than if it were to hold on to those loans. If I was a SoFi investor, which I'm not, I don't own SoFi stock, but if I was, I would like this strategy. I would take the 5% or above 5% rate of return here on the origination without holding on to the risk, because this is also a more scalable business model. If you're holding on to the loans, you're going to reach a cap where you can't make any more loans because you're not going to have the capital to make those loans. And the growth will not be as speedy as if you're originating and selling. But the difficulty is when you're trying to do this originate and sell, you're at the mercy of lenders who may or may not want to buy. So you can't rely on this completely. As I saw from one of SoFi's competitors, Upstart, which tried to do completely hands off, not making any of the loans itself, just becoming a platform and just originating and then having lenders fund those loans entirely. But when fears of a recession started to creep up, Upstart noticed that lenders pulled back from the platform and they didn't want to make loans. And so the business stalls in those events. But if you can have a mix where you can fund the loans yourself, but also you can sell some to third parties in times of boom when they are very interested in borrowing, it can alleviate some concerns, some risk from the business. And I like that SoFi is doing this. And I like that they found a partner or partners to sell off $1 billion in personal loans. Remember, these are the riskiest types of loans. And so to find buyers for the riskiest of the loans that you're making is a really good sign of growth potential in the business longer term. I mentioned one of the reasons why people like SoFi is it continues to offer a top tier annual percentage yield of up to 4.3% as of October 29th, with no minimum balance requirement or balance limits. And they get FDIC insurance through a network of participating banks up to 2 million and a host of free features and unique rewards program. So the services, the incentives, the promotions that SoFi offers customers is working. It's working. They've added millions and millions. They've almost reached 10 million customers that have deposited $24.4 billion with SoFi. The strategy is working, and I don't see any reason why it will not continue working. They have a huge advantage over the brick and mortar locations, unless these banks that have the brick and mortar locations actually change tact and make those brick and mortar locations more valuable to their customers by staffing them better, by training the people there better, by offering more to people that walk in. And I don't see that happening because that would require a huge hiring program with a lot of training, and banks are going in the opposite direction, trying to do more with less people. So I don't see that reversing, and so I think the future looks bright for SoFi with this strategy. Now, another interesting data point was that in the third quarter, lending revenue increased by 14% from the prior year period. Remember, coming into this year, SoFi was telling investors that lending revenue was going to decrease. They said lending revenue was going to decrease anywhere between 5 to 8% for 2024, and that's turned out much better than expected. SoFi thought that we would be in a much more difficult macroeconomic environment. They thought unemployment rates would be higher. They thought inflation might be higher. They thought economic activity would be slower, and so they did not want to make as many loans in that difficult macroeconomic environment, because when people are losing their jobs, they're more likely to default on their loans. And so SoFi was being prudent and telling investors they plan to make a lot fewer loans. But it turns out that the economy has performed much better than expected, and SoFi has upgraded their target, and I'll mention that a little bit later in the video. And yet another excellent data point was looking at the weighted average annual default rates of SoFi's personal loan portfolio, which is by far the largest segment in SoFi's loan portfolio. Over 80% of its loan portfolio is in personal loans. And the weighted average default rate you can see here is the highest for personal loans, way higher than student loans. but you could see it dropping from June 30th, 2024, where it was 4.8% to 4.5% in the latest quarter. So that was great news that the riskiest of its loans are performing much better than they were just a few months ago. And this really alleviated concerns from rising defaults in SoFi's personal loan portfolio. I mentioned this, the largest segment, personal loans originations totaled $5 billion in the latest quarter, which is up 26% year over year. And that includes the $1 billion that it sold off. So in more good news, the cumulative fair value adjustments from delinquent personal loans peaked in the first quarter of 2024, and it's improved since then. So the default rates have improved after peaking in the first quarter of 2024. Personal loan annual charge-off rates decreased to 3.52% from 3.84% in the prior quarter. So default rates are actually decreasing for SoFi. That's great news. That's the opposite of what the management team was expecting. So all in all, some really great data points here for SoFi stock investors to digest, in spite of the fact that the stock price is down by more than 10% following this earnings announcement. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.